Welcome to this exam review from Birdsey, your AI-powered study partner. Be sure to like and subscribe for more videos, and don't miss what's happening in the lower corner of the screen. It could be just the thing you need to pass your exam. Let's get started.
Let's begin with a review of amortization and loan structure. Amortization schedules, payment components, and interest allocation. What is the primary purpose of an amortization schedule in a loan structure? Is it A, to show the breakdown of each payment into principal and interest? B, to determine the total interest paid over the life of the loan? C, to calculate the loan's interest rate? Or D, to provide a payment history for tax purposes? The answer is A, to show the breakdown of each payment into principal and interest. An amortization schedule outlines the breakdown of each loan payment into principal and interest, helping borrowers understand how their loan balance decreases over time. In an amortization schedule, what happens to the interest portion of the payment as the loan progresses? Is it A, it remains constant throughout the loan term? B, it increases as the loan progresses? C, it decreases as the principal balance is paid down? Or D, it fluctuates based on market interest rates? The answer is C, it decreases as the principal balance is paid down. Why this question may seem a bit tricky. Borrowers often assume payments remain static, but the interest portion decreases as the principal is paid down, increasing the principal portion. John has a 30-year fixed-rate mortgage and notices his monthly payment remains the same, but the interest portion decreases over time. What explains this change? Is it A, John's interest rate has decreased? B, the principal portion of the payment increases as the loan progresses? C, John's loan term has been extended? Or D, John made extra payments toward the principal? The answer is B. The principal portion of the payment increases as the loan progresses. In a fixed-rate mortgage, the total payment stays constant, but the interest portion decreases as the principal is paid down, increasing the principal portion. How does the principal portion of a loan payment change over time in a standard amortization schedule? Is it A, it remains constant throughout the loan term? B, it decreases as the loan progresses? C, it fluctuates based on the remaining balance? Or D, it increases as the interest portion decreases? The answer is D. It increases as the interest portion decreases. In a standard amortization schedule, the principal portion of each payment increases over time as the interest portion decreases. Maria is reviewing her loan's amortization schedule and sees that her monthly payments are mostly interest at the start. What does this indicate about her loan? Is it A, her loan is in its early stages with a high principal balance? B, her interest rate has increased unexpectedly? C, she has missed previous payments, increasing interest charges? Or D, her loan term has been shortened, increasing interest payments? The answer is A. Her loan is in its early stages with a high principal balance. In the early stages of a loan, payments are interest-heavy because the principal balance is still high, resulting in more interest being charged.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
In a typical amortization schedule, what happens to the principal portion of the payment over time? Is it A, it remains constant? B, it increases? C, it decreases? Or D, it fluctuates randomly? The answer is B, it increases. As the loan progresses, The principal portion of each payment increases because the interest is calculated on a decreasing balance. In an amortization schedule, if the interest rate increases, what happens to the interest portion of the payment? Is it A, it decreases, B, it remains the same, C, it increases, or D, it is unaffected? The answer is C, it increases. Why this question may seem a bit tricky. An increase in interest rates affects new loans or variable rate loans, increasing the interest portion, but it doesn't affect fixed-rate loans. Lisa has a 15-year fixed-rate mortgage and notices her monthly payment is mostly principal towards the end of the term. What does this indicate about her loan? Is it A, her interest rate has increased, B, her loan term has been extended, C, her payments have decreased, or D, her loan is nearing completion? The answer is D, her loan is nearing completion. As the loan progresses, more of each payment goes towards the principal, reducing the balance faster towards the end of the term. What is the effect of making extra payments on a loan's amortization schedule? Is it A, it reduces the total interest paid, B, it increases the monthly payment, C, it extends the loan term, or D, it has no effect on the loan? The answer is A, it reduces the total interest paid. Making extra payments reduces the principal balance, which decreases the total interest paid and shortens the loan term. Tom has a variable rate loan and notices his monthly payment has increased. What is the most likely reason for this change? Is it A, his loan term has been shortened, B, the interest rate has increased, C, he missed a payment, or D, the principal balance has increased? The answer is B, the interest rate has increased. Variable rate loans are subject to interest rate changes, which can increase the monthly payment if rates rise.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Fixed rate versus adjustable rate loan behavior over time. What is a key characteristic of a fixed rate mortgage? Is it A, constant interest rate, B, interest rate changes annually, C, interest rate changes monthly, or D, interest rate changes with inflation? The answer is A, constant interest rate. A fixed-rate mortgage has a constant interest rate throughout the life of the loan, providing predictable monthly payments. Which type of mortgage might initially offer lower interest rates, but can become more expensive over time? Is it A, fixed-rate mortgage, B, adjustable-rate mortgage, C, interest-only mortgage, or D, balloon mortgage? The answer is B, adjustable-rate mortgage. Why this question may seem a bit tricky. Adjustable-rate mortgages often start with lower rates, but these can increase significantly, making them more costly. John is considering a mortgage and wants stable payments over 30 years. Which type of loan should he choose? Is it A, fixed-rate mortgage, B, adjustable-rate mortgage, C, balloon mortgage, or D, interest-only mortgage? The answer is A, fixed-rate mortgage. A fixed-rate mortgage offers stable payments over the life of the loan, which aligns with John's preference for predictability. How does an adjustable-rate mortgage typically adjust its interest rate? Is it A, based on the borrower's credit score, B, based on the lender's discretion, C, based on a financial index, or D, based on the local real estate market? The answer is C, based on a financial index. Adjustable-rate mortgages adjust their interest rates based on an index such as the LIBOR or Treasury rates. Lisa has an adjustable-rate mortgage and is concerned about rising interest rates. What is a potential risk she faces? Is it A, her loan term will shorten, B. Her interest rate will become fixed. C. Her loan balance will increase. Or D. Her monthly payments will increase. The answer is D. Her monthly payments will increase. Lisa faces the risk of increased monthly payments if interest rates rise, which is a common concern with adjustable-rate mortgages. What is a primary advantage of a fixed-rate mortgage over an adjustable-rate mortgage? Is it A. Lower initial interest rates, B. Predictable monthly payments, C. Potential for lower payments over time, or D. Flexibility in loan terms? The answer is B. Predictable monthly payments. A fixed-rate mortgage offers predictable monthly payments, which is a key advantage over an adjustable-rate mortgage that can fluctuate with interest rate changes. How might an adjustable-rate mortgage behave if interest rates decrease significantly over time? Is it A. The monthly payments will remain the same, B. The interest rate will increase, C. The interest rate may decrease, lowering payments, or D. The loan will convert to a fixed-rate mortgage? The answer is C. The interest rate may decrease, lowering payments. Why this question may seem a bit tricky, adjustable-rate mortgages can benefit from decreasing rates, but this depends on the timing and terms of rate adjustments, which are not guaranteed to align perfectly with market trends. Emily has a 5-1 adjustable-rate mortgage and is worried about future interest rate hikes. What is a potential outcome if rates increase after the initial fixed period? Is it A. Her monthly payments could increase significantly, B. Her interest rate will remain fixed for the loan's duration, C. She will automatically refinance to a lower rate, or D. Her loan term will be extended? The answer is A. Her monthly payments could increase significantly. After the initial fixed period, Emily's interest rate and monthly payments could increase if market rates rise, impacting her budget. Negative amortization, interest-only periods, and balloon features. What is a characteristic of a loan with negative amortization? Is it A. The loan balance decreases over time, B. The loan balance increases over time, C. The interest rate decreases over time, or D. The loan term is extended automatically? The answer is B. The loan balance increases over time. Negative amortization occurs when the loan payment is less than the interest charged, causing the loan balance to increase over time. During an interest-only period, what happens to the principal balance of the loan? Is it A. It decreases with each payment, B. It increases with each payment, C. It remains unchanged unless extra payments are made, or D. It is automatically reduced by the lender? The answer is C. It remains unchanged unless extra payments are made. Why this question may seem a bit tricky, the term interest-only might suggest no change in principal, but it actually remains unchanged unless additional payments are made. John has a loan with a balloon payment due in 5 years. What must he do to avoid default when the balloon payment is due? Is it A. Refinance the loan or pay the balloon payment in full, B. Request an extension from the lender, C. Convert the loan to a fixed-rate mortgage, or D. Ignore the balloon payment until the lender contacts him? The answer is A. Refinance the loan or pay the balloon payment in full. John must either refinance the loan, sell the property, or have the funds available to pay the balloon payment to avoid default. What is a balloon payment in the context of a loan? Is it A. A regular monthly payment that gradually reduces the principal, B. An interest-only payment made periodically, C. A payment that reduces the interest rate, or D. A large payment due at the end of the loan term? The answer is D. A large payment due at the end of the loan term. A balloon payment is a large payment due at the end of a loan term, often used to reduce monthly payments during the loan. If a borrower chooses an interest-only loan, what is the impact on their monthly payments compared to a fully amortizing loan? Is it A, monthly payments are higher initially? B, monthly payments are lower initially? C, monthly payments remain constant throughout the loan term? Or D, monthly payments increase each year? The answer is B, monthly payments are lower initially. Why this question may seem a bit tricky. Interest-only loans have lower initial payments, but the borrower must eventually pay the principal, which can lead to higher costs later. What happens to the principal balance of a loan during a negative amortization period? Is it A, the principal balance decreases? B, the principal balance increases? C, the principal balance remains the same? Or D, the principal balance is unaffected by interest payments? The answer is B, the principal balance increases. During negative amortization, the loan's principal balance increases because the payments made are less than the interest due, causing unpaid interest to be added to the principal. Emily has an interest-only loan with a balloon payment due in 10 years. What is a likely consequence if she only makes interest payments throughout the loan term? Is it A, the loan will be fully paid off by the end of the term? B, the principal balance will gradually decrease over time? C, she will need to pay the entire principal as a balloon payment? Or D, the interest rate will automatically decrease? The answer is C, she will need to pay the entire principal as a balloon payment. Emily will face a large balloon payment at the end of the term because she has not reduced the principal balance by making only interest payments.
Notice the code in the corner? When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Adjustable rate mortgages. Index, margin, rate caps, floors, and adjustment mechanics. What is the primary function of the index in an adjustable rate mortgage? Is it A, to serve as a benchmark for interest rate adjustments? B, to determine the initial interest rate of the loan? C, to cap the maximum interest rate of the loan? Or D, to calculate the monthly payment amount? The answer is A, to serve as a benchmark for interest rate adjustments. The index in an ARM serves as a benchmark interest rate that reflects market conditions, influencing how the loan's interest rate adjusts over time. In an ARM, what does the margin represent? Is it A, the maximum interest rate increase allowed? B, a fixed percentage added to the index to set the interest rate? C, the initial interest rate of the loan? Or D, a minimum interest rate the loan can reach? The answer is B, a fixed percentage added to the index to set the interest rate. Why this question may seem a bit tricky. The margin is often confused with the index or rate caps, but it is a fixed percentage added to the index to determine the loan's interest rate. John has an ARM with a 2% margin and a current index rate of 3%. If his rate cap is 5%, what is the maximum interest rate he could be charged at the next adjustment? Is it A, 3%, B, 4%, C, 5%, or D, 6%? The answer is C, 5%. The maximum interest rate is determined by adding the margin to the index, but it cannot exceed the rate cap, which is 5% in this case. What is a rate floor in the context of an ARM? Is it A, the initial interest rate of the loan? B, the maximum rate increase allowed at each adjustment? C, the average interest rate over the loan term? Or D, the minimum interest rate the loan can reach? The answer is D, the minimum interest rate the loan can reach. A rate floor is the lowest interest rate that can be charged on an ARM, regardless of how low the index may fall. Emily's ARM has a 1-year adjustment period with a 2% periodic cap. If her current rate is 4% and the index increases by 3%, what will her new rate be? Is it A, 4%, B, 6%, C, 7%, or D, 5%? The answer is B, 6%. The periodic cap limits the rate increase to 2%, so her new rate will be 6%, not the full 7% increase from the index. What is the purpose of a rate cap in an adjustable rate mortgage? Is it A, to determine the initial interest rate of the loan? B, to limit the amount the interest rate can increase during adjustment periods? C, to set a minimum interest rate for the loan? Or D, to adjust the margin applied to the index rate? The answer is B, to limit the amount the interest rate can increase during adjustment periods. Rate caps limit how much the interest rate can increase during adjustment periods, protecting borrowers from drastic rate hikes. In an ARM, if the index rate decreases but the margin remains constant, what happens to the overall interest rate? Is it A, the overall interest rate decreases? B, the overall interest rate remains unchanged? C, the overall interest rate increases? Or D, the overall interest rate is unaffected by changes in the index? The answer is A, the overall interest rate decreases. Why this question may seem a bit tricky, the overall interest rate is the sum of the index rate and the margin. If the index decreases and the margin stays the same, the overall rate decreases. Sarah has an ARM with a 3% margin and a current index rate of 2%. If her loan has a rate floor of 4%, what will her interest rate be if the index rate drops to 1%? Is it A, 3%, B, 3.5%, C, 4%, or D, 5%? The answer is C, 4%. The calculated rate would be 4%, 3% margin plus 1% index, but the rate floor ensures the interest rate cannot go below 4%. Hybrid ARM structures and reset behavior. What does the 5 represent in a 5-1 hybrid ARM? Is it A, the loan term is 5 years? B, the fixed rate period is 5 years? C, the interest rate adjusts every 5 years? Or D, the loan is reviewed every 5 years? The answer is B, the fixed rate period is 5 years. In a 5-1 hybrid ARM, the 5 indicates the initial fixed rate period lasts for 5 years before the interest rate begins to adjust annually. In a 7-1 ARM, what happens after the initial 7-year period? Is it A, the loan converts to a fixed rate mortgage? B, the interest rate remains fixed for another 7 years? C, the interest rate adjusts annually? Or D, the loan term ends? The answer is C, the interest rate adjusts annually. Why this question may seem a bit tricky. The term 7-1 can be misleading. After 7 years, the interest rate adjusts annually, not every 7 years. John has a 3/1 ARM and is approaching the end of the 3rd year. What should he expect regarding his interest rate? Is it A, the interest rate will adjust annually? B, the interest rate will remain fixed for another 3 years? C, the loan will convert to a fixed rate mortgage? Or D, the loan term will end? The answer is A, the interest rate will adjust annually. After the initial 3-year fixed period, John's interest rate will begin to adjust annually based on the index and margin. What does the 1 signify in a 5-1 ARM? Is it A, the loan term is 1 year? B, the interest rate adjusts every 5 years? C, the fixed rate period is 1 year? Or D, the interest rate adjusts annually? The answer is D, the interest rate adjusts annually. In a 5-1 ARM, the 1 indicates that after the initial fixed rate period, the interest rate adjusts annually. Lisa is considering a 7-1 ARM and wants to know what happens if she keeps the loan past the 7th year. What should she expect? Is it A, the interest rate will remain fixed indefinitely? B, the interest rate will adjust annually? C, the loan will automatically refinance? Or D, the loan will be paid off? The answer is B, the interest rate will adjust annually. After the initial 7-year fixed period, Lisa should expect her interest rate to adjust annually based on the index and margin. Emma has a 5-1 ARM and is nearing the end of the initial 5-year period. She is concerned about her interest rate changing. What should she expect regarding the interest rate reset? Is it A, the interest rate will adjust annually based on an index? B, the interest rate will remain fixed for another 5 years? C, the interest rate will reset monthly? Or D, the interest rate will decrease automatically? The answer is A, the interest rate will adjust annually based on an index. After the initial fixed rate period, in a 5-1 ARM, the interest rate resets annually based on the index plus a margin. Emma should expect her rate to adjust each year thereafter. Common ARM misunderstandings: teaser rates, payment shock, and fully indexed rate. What is a teaser rate in the context of an adjustable rate mortgage? Is it A, the final interest rate after the adjustment period? B, a low initial interest rate that increases after a set period? C, a rate that remains constant throughout the loan term? Or D, the maximum interest rate cap on an ARM? The answer is B, a low initial interest rate that increases after a set period. A teaser rate is a low initial interest rate offered on an ARM which increases after a set period. How does the fully indexed rate of an ARM differ from the initial teaser rate? Is it A, the fully indexed rate is always lower than the teaser rate? B, the teaser rate is adjusted based on the index rate? C, the fully indexed rate includes the index rate plus the margin? Or D, the teaser rate is the same as the fully indexed rate? The answer is C. The fully indexed rate includes the index rate plus the margin. Why this question may seem a bit tricky: the fully indexed rate includes the index rate plus the margin, which is often higher than the teaser rate. John has an ARM with a teaser rate of 3% for the first year, after which it adjusts to the fully indexed rate. What should John expect after the first year? Is it A, his interest rate will increase to the fully indexed rate? B, his interest rate will remain at 3% for the entire loan term? C, his interest rate will decrease to a lower rate? Or D, his interest rate will be capped at 3% for the next adjustment period? The answer is A, his interest rate will increase to the fully indexed rate. John should expect his interest rate to increase to the fully indexed rate, which is typically higher than the teaser rate. What is payment shock in the context of ARMs? Is it A, the initial low payment during the teaser rate period? B, a sudden decrease in monthly payments after the adjustment period? C, the maximum interest rate cap on the loan? Or D, a significant increase in monthly payments after the initial rate period? The answer is D, a significant increase in monthly payments after the initial rate period. Payment shock occurs when a borrower's monthly payment increases significantly after the initial rate period ends. Sarah's ARM is about to adjust from a teaser rate of 2% to a fully indexed rate. What financial impact should she prepare for? Is it A, Her monthly payments will decrease. B. She may experience payment shock due to increased payments. C. Her interest rate will remain at 2% indefinitely. Or D. Her interest rate will be capped at 2% for the next adjustment period. The answer is B. She may experience payment shock due to increased payments. Sarah should prepare for a potential payment shock as her monthly payments are likely to increase with the new rate. QM versus non-QM products. Qualified mortgage standards, ATR rules, and safe harbor requirements. What is a key characteristic of a qualified mortgage? Is it A, a debt-to-income ratio of no more than 43%? B, no requirement for income verification? C, interest-only payments allowed? Or D, no prepayment penalties? The answer is A, a debt-to-income ratio of no more than 43%. A QM must have a debt-to-income ratio of no more than 43%, ensuring borrowers can repay the loan. Which of the following is true about non-QM loans? Is it A, they are illegal under federal law? B, they do not provide the same legal protections as QM loans? C, they must have a fixed interest rate? Or D, they require a lower credit score than QM loans? The answer is B, they do not provide the same legal protections as QM loans. Why this question may seem a bit tricky. Non-QM loans do not meet QM standards, but can still be viable options for borrowers who don't fit traditional criteria. John is applying for a mortgage with a debt-to-income ratio of 50% and a history of self-employment income. Which type of mortgage is he most likely to qualify for? Is it A, qualified mortgage? B, FHA loan? C, non-qualified mortgage, non-QM? Or D, VA loan? The answer is C, non-qualified mortgage, non-QM. John's high debt-to-income ratio and self-employment income suggest a non-QM loan, as QM loans require a lower ratio and stricter income verification. What is the purpose of the ability to repay rule? Is it A, to allow lenders to offer interest-only loans? B, to eliminate the need for credit checks? C, to provide borrowers with lower interest rates? Or D, to ensure lenders verify a borrower's ability to repay the loan? The answer is D, to ensure lenders verify a borrower's ability to repay the loan. The ATR rule ensures lenders assess a borrower's ability to repay the loan, preventing risky lending practices. Emily is considering a mortgage that offers a safe harbor provision. What does this mean for her as a borrower? Is it A, the loan is presumed to comply with ATR rules, providing legal protection? B, the loan has no closing costs? C, the loan offers a lower interest rate? Or D, the loan allows for interest-only payments? The answer is A, the loan is presumed to comply with ATR rules, providing legal protection. A safe harbor provision means the loan is presumed to comply with ATR rules, offering Emily legal protection against foreclosure. Which of the following is a requirement for a mortgage to be considered a qualified mortgage? Is it A, the loan must have a balloon payment? B, the loan must meet specific underwriting standards? C, the loan must have an interest-only payment option? Or D, the loan must allow negative amortization? The answer is B, the loan must meet specific underwriting standards. A QM must not have negative amortization, interest-only payments, or balloon payments, and must meet specific underwriting standards. Non-QM loan types, bank statement loans, DSCR loans, interest-only, etc. What is a primary feature of a non-QM bank statement loan? Is it A, requires a high credit score? B, uses bank statements to verify income? C. Offers lower interest rates than QM loans. Or D. Requires a large down payment. The answer is B. Uses bank statements to verify income. Non-QM bank statement loans primarily use bank statements to verify income, rather than traditional income documentation like W-2s or tax returns. Which of the following is not a characteristic of a non-QM loan? Is it A. Flexible income verification? B. Interest-only payment options? C. Government-backed guarantees? Or D. Higher interest rates? The answer is C. Government-backed guarantees. Why this question may seem a bit tricky: non-QM loans can have flexible terms, but they do not necessarily have government backing, which is a feature of QM loans. John is self-employed and applies for a mortgage using his bank statements to verify income. What type of loan is he most likely applying for? Is it A. Bank statement loan? B. Traditional QM loan? C. DSCR loan? Or D. Interest-only loan? The answer is A. Bank statement loan. John is likely applying for a bank statement loan, a type of non-QM loan that allows self-employed individuals to verify income through bank statements. What does DSCR stand for in the context of non-QM loans? Is it A. Debt Service Credit Rating? B. Direct Service Credit Ratio? C. Debt Security Coverage Rate? Or D. Debt Service Coverage Ratio? The answer is D. Debt Service Coverage Ratio. DSCR stands for Debt Service Coverage Ratio, a key metric used in non-QM loans to assess the borrower's ability to cover debt obligations. Evely is considering a loan where she only pays interest for the first 5 years. What type of loan is she likely looking at? Is it A. Fixed rate loan? B. Adjustable rate mortgage? C. Interest-only loan? Or D. Balloon payment loan? The answer is C. Interest-only loan. Emily is likely considering an interest-only loan where the borrower pays only the interest for a set period before principal payments begin. Common misinterpretations: DTI limits, points, fees, caps, and product eligibility. What is the maximum allowable debt-to-income ratio for a qualified mortgage? Is it A. 43%, B. 50%, C. 36%, or D. 45%? The answer is A. 43%. The maximum DTI ratio for a QM is typically 43%. This is a standard set by the Consumer Financial Protection Bureau to ensure borrowers can reasonably afford their loans. Which of the following is true about points and fees caps for non-QM loans? Is it A. They are capped at 3% of the loan amount? B. They do not have a specific regulatory cap? C. They are capped at 5% of the loan amount? Or D. They must be less than 2% of the loan amount? The answer is B. They do not have a specific regulatory cap. Why this question may seem a bit tricky: non-QM loans do not have the same regulatory caps on points and fees as QM loans, leading to potential confusion about their limits. John is applying for a mortgage, and his lender offers him a non-QM loan because his DTI is 48%. What is a likely reason for this loan type being offered? Is it A. He has a perfect credit score? B. He wants a lower interest rate? C. His DTI exceeds the QM limit of 43%? Or D. He is self-employed? The answer is C. His DTI exceeds the QM limit of 43%. Non-QM loans are often used when borrowers exceed the 43% DTI limit of QM loans, allowing flexibility for higher DTI ratios. Sarah is considering a mortgage and is confused about product eligibility. Her lender mentions that her loan does not qualify as a QM because of the interest-only feature. What should Sarah understand about this feature? Is it A, interest-only loans are always QM? B, interest-only loans have lower points and fees? C, interest-only loans have no DTI limits? Or D, interest-only loans do not meet QM standards? The answer is D. Interest-only loans do not meet QM standards. Interest-only loans are typically classified as non-QM because they do not meet a standard QM criteria, which require regular principal and interest payments. Secondary market and loan delivery. Role of Fannie Mae, Freddie Mac, and Ginnie Mae. What is the primary role of Fannie Mae in the secondary mortgage market? Is it A, to originate new mortgages directly to consumers? B, to provide liquidity by purchasing mortgages from lenders? C, to insure mortgages against default? Or D, to regulate interest rates on mortgages? The answer is B, to provide liquidity by purchasing mortgages from lenders. Fannie Mae primarily purchases mortgages from lenders, providing them with liquidity to issue more loans. This helps stabilize the mortgage market by ensuring a steady flow of funds. Why might someone mistakenly believe that Ginnie Mae buys mortgages like Fannie Mae and Freddie Mac? Is it A, because Ginnie Mae is a government-sponsored enterprise? B, because it provides liquidity to the mortgage market? C, because it guarantees mortgage-backed securities? Or D, because it sets mortgage interest rates? The answer is C, because it guarantees mortgage-backed securities. Why this question may seem a bit tricky, Ginnie Mae is often grouped with Fannie Mae and Freddie Mac, but it does not buy mortgages. Instead, it guarantees mortgage-backed securities, which can be confused with purchasing loans. A lender is deciding whether to sell a pool of mortgages to Fannie Mae or Freddie Mac. What factor might influence this decision? Is it A, differences in underwriting guidelines and pricing? B, the lender's ability to originate new loans? C, the geographic location of the lender? Or D, the lender's relationship with Ginnie Mae? The answer is A, differences in underwriting guidelines and pricing. Fannie Mae and Freddie Mac have different underwriting guidelines and pricing structures, which can affect a lender's decision based on the specific characteristics of the mortgage pool. Mortgage-backed securities basics and capital market interactions. What is the primary purpose of mortgage-backed securities in the capital markets? Is it A, to increase interest rates for borrowers? B, to reduce the risk for individual investors? C, to provide liquidity to the mortgage market? Or D, to eliminate the need for mortgage insurance? The answer is C, to provide liquidity to the mortgage market. MBS are primarily used to provide liquidity to the mortgage market by allowing lenders to sell their mortgage loans, freeing up capital to issue more loans. A bank has a portfolio of mortgage loans and wants to increase its lending capacity. What action involving mortgage-backed securities could the bank take to achieve this goal? Is it A, increase interest rates on existing loans? B, securitize the loans into mortgage-backed securities? C, require borrowers to refinance their loans? Or D, purchase additional mortgage insurance? The answer is B, securitize the loans into mortgage-backed securities. By securitizing its mortgage loans into MBS, the bank can sell these securities to investors, thus freeing up capital to issue more loans. Loan delivery, overlays, and repurchase triggers. A lender is preparing a loan for delivery to the secondary market, but discovers a discrepancy in the borrower's income documentation. What should the lender do to avoid a repurchase trigger? Is it A, ignore the discrepancy and proceed with delivery? B, deliver the loan, and address the discrepancy later. C. Resolve the discrepancy before delivery. Or D. Cancel the loan delivery entirely. The answer is C. Resolve the discrepancy before delivery. The lender should resolve the discrepancy before delivery to ensure compliance with investor guidelines, thus avoiding a repurchase trigger.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit birdsey.ai to start your free trial of Birdsey, your AI-powered study partner.